Wall Street analysts have a tough job. They're expected to come up with the crystal ball number for every stock, bond, commodities, and the entire market. They're considered the industry experts. None of this means they're always right. Every investment bank is busy coming up with the next year's forecast. We had a pretty bad year and everyone's looking for a glimmer of hope. So let's look at the consensus. On average, S&P 500 index is expected to close at 4,000 by the end of 2023. That's a mere 2.5% increase from now. But the problem is, we now live in a world where S&P and the Nasdaq moves 5%, 7% intraday on a bad or a good day, and 1 to 2% on a normal day. So this essentially means that the stock market will stay flat next year, according to Wall Street. So it looks like the prediction band ranges from 34 to 4,500. But then you start to wonder, are they right? So let's go back in time and check out their projections for this year, last year. Just 12 months ago, Wall Street was calling out numbers median 5,000. Clearly hopeful overall, some touting numbers above 5,000. Note that these estimates started to get aggressively revised down throughout the year as the market started to tumble mid-January. The S&P 500 tumbled at the speed of negative 32% annualized loss and is still hovering around the 38 to 3,900 band at the 20% fall from the beginning of the year. The Wall Street analysts estimate the financials of the S&P 500 companies from top line all the way down to the bottom line numbers. We call that net income or net loss. From there, they come up with the EPS, earnings per share. Then they aggregate the individual company EPS to build an S&P 500 EPS, which is what they call bottom-up analysis. So last year, analysts predicted this year's S&P 500 to yield the EPS of $221 per share. With 2022 less than a week left, it is increasingly likely that the companies will actually hit that 221 EPS with plus or minus 2% margin of error. So they got this part right. So another component is the multiple, price to earnings ratio. Analysts estimate the price of the S&P index by multiplying their best estimate of the EPS with their best estimate of the forward multiple to be more accurate. Now this is the tricky part. The stock market closed nearly 23 times in December 2021. We are now at around 17.5. Before the market crashed this year, most investment banks came out with 21 times forward multiple on average. So let's do some grade 3 math. 221 times 21 equals 4,641. S&P 500 today is nowhere near that. Clearly, they got this multiple part messed up. Consensus can be wrong, consensus can be right. And when they're right, they can be right for the wrong reasons. So let's circle back again around this time next year.